to our second episode of What the Hell is Going On Out There. Now, in this episode, we're going to cover the recent interest rate changes by the Federal Reserve in response to the unprecedented health crisis caused by the novel coronavirus, as well as why this has caused a surge in home refinancing. And we want to know, why the hell is this all over the news, and why should you care about this? How is this going to impact me? And basically, what the hell is going on with interest rates? So let's start with the basics. First, I know there's been a ton of news to digest over the past few weeks, and it's understandable if you, even like me, have been fairly overwhelmed by the sheer amount of stuff happening in the world. One of those things that's been changing drastically in this short time is the financial and economic situation faced by billions of people around the globe. So people have been and continue to lose their jobs at an unprecedented rate, and global consumer spending has dropped substantially as a result. Because of course, if we don't get paid, we can't buy all the things that are constantly being sold to us, or we can't pay for all the things that we need to survive. So that has caused a crisis of funds for a great many businesses and individuals, both large and small. This I expect you will have seen evidence of. Businesses of all kinds are reaching out for help as they begin to struggle with vastly decreased revenues, ranging from local restaurants encouraging you to get out, get takeout, or buy a gift card or a t-shirt, all the way to major corporations refusing to refund customers or canceling events or beseeching the government for a bailout. But by and large, their main concern, both individuals and companies, is that they're going to run out of money to pay their bills while everyone and their mother is quarantined, instead of spending their hard-earned money. So that includes paying employee salaries as well as the normal bills and expenses associated with running a business. Now, if we expect that this crisis will be a relatively quick one, companies may start looking for some short-term financing to cover their expenses until everything returns to some level of normalcy. If, on the other hand, we expect that this crisis is going to have a more long-lasting impact, companies are going to need to seek larger and more significant resources in order to stay afloat through the hard times. So will people. Companies, on one hand, we know that companies can finance themselves and their projects via 3 different channels. We talked about them. 1 is selling equity shares so they can sell a part of the company. 2 is taking out loans from banks or issuing public debt in the form of bonds. And 3 is raiding the piggy bank, the firm's savings account. Now, these are also the channels through which companies can seek a lifeline for help to help them through a crisis period like the one we saw in 2008 and the one we're all experiencing now. However, this crisis has affected all of those channels and a company's ability to access those channels in a major way. So first, we talked in the first episode about the current state of the stock market, but we mainly focused on the effect on individual investors. However, a crashing stock market also has a big impact on the companies themselves. In this case, it has an impact on the company's ability to sell more shares and raise additional money via the equity channel. Certainly, it has affected an investor's willingness to buy new shares from a struggling company, but it has also affected the amount of money a company could raise ultimately. So consider a company whose share price was $100 before the crash and whose shares are now worth $70. That means if they tried to sell 10 shares, they would be able to raise 30% less money than before the crisis. So these 2 things, an investor's willingness to buy shares from a struggling company and a company's ability to sell shares at the same value, they both combine to make equity both more difficult to sell and an unappealing way to raise money for management. Now, second, a company could raise the piggy bank. Or they could raid the piggy bank, rather. But if they could do that, they wouldn't be in trouble to start with. Remember that the piggy bank, the firm's savings account, gets replenished via retained earnings, which comes out of net income, profit. And if companies aren't making revenue, then they aren't making profit. And poof, whatever was in the piggy bank will slowly or quickly start dwindling as the company needs to raid the piggy bank to start to pay expenses. So lastly, a company can try to take out some loans to tide them over, in much the same way that we as individuals might use a credit card to buy groceries on the day before payday. Credit can be a big help to manage the finances of a firm when the revenue from operations is no longer as consistent as it used to be. However, credit isn't free. Whether it comes directly from a bank or from selling bonds to public investors, there is always a cost to borrowing money. We know that. The cost is called the interest rate. Remember when we discussed how interest rates are determined? We estimated all of the risks of making a loan, and then we add a premium to our baseline rate. Remember, our baseline rate is the time value of money, until we arrive at an interest rate that is high enough to justify the risk we take by lending out money. The problem for all companies right now is that the risks, all of the risks associated with lending or borrowing money, are high across the board. So all of the risks that we talked about would be so high that many companies probably can't afford to borrow money because they can't afford to pay the interest payments. And that's especially now that they're all making lower revenues. So what's going on? You may remember from your economics classes that the Federal Reserve Bank of the United States, which is more commonly called the Fed, is what's called a central government bank. And one of the main functions of a central government bank, and thus one of the main functions of the Fed, is to act as a lender of last resort to other commercial banks, if and when those banks need to borrow money. Now this happens all the time. During normal times, crisis times, banks are always borrowing money from the Fed. What's important for the current situation, and what's been in the current news a lot, is that the Fed sets the interest rate that they charge other banks, which is called the federal funds rate, at a series of quarterly meetings that are followed extremely closely by the financial world. This is because the federal funds rate helps determine the baseline rate that we use, the time value of money. And they help determine the baseline interest rate that's acceptable in the broader market. So this is part of what determines all of the other loan rates that are set. So it's even part of how the banks determine the interest rates they choose to lend to individual consumers, like you. So for that reason, one of the ways the Fed can help the economy in times of crisis is to lower its own federal funds rate. And this is despite the fact that the banks that are going to be borrowing at this rate are all experiencing the higher risks that every other public company and individual in the economy is facing. But because the Fed has governmental backing, it can afford to take on the higher risk in order to provide some help to the economy. So when you hear about the Fed lowering rates, this is what's being referred to. In this case, the Fed has lowered the rates it's willing to lend to other banks at. And this is in hopes that these banks will pass on the lower rates to consumers and to other businesses that need to borrow money in times of crisis. So several weeks ago at the quarterly federal meeting, the Fed took the unprecedented move of lowering rates by more than 1 percentage point to a lending rate that's very nearly zero. They now stand ready to lend to major US banks at a rate of 0.25%, which is historically low. If all goes according to plan, these banks will lend to businesses, big and small, and consumers as well, hopefully, at much lower rates, thus helping everyone stretch their finances and cover their costs until things get back to normal. So, why is everybody talking about refinancing their house? Well, the Fed also hopes that these banks are going to extend low-rate loans to consumers who are facing many of the same pressures as the business community. However, consumers generally have less ability to use bank loans for personal spending than a business does to use bank loans for business spending. However, one of the major ways we can use cheap loans is to buy a house. Remember, a house loan is called a mortgage. Or to buy a car. And both of those types of loans are now experiencing historically low rates as well. In other words, now is the cheapest time to get a loan for a car or a house in the last 30 years or more. Consumer rates for car loans are below 2% interest. And for house loans, the average 30-year rate is around 3.5% or even lower now. And just last year, the average 30-year house loan rate was near 5%. So this is a massive drop in rates. Now that might not help you if, like me, you already have a house or a car loan. Because remember, a loan is a contract. And whatever rate I agree to when I sign the contract is never going to change. No matter what happens to market rates, the contract has already been signed. So I do, however, have one option left to me. And that is, I can sign a new contract for a new loan that will replace my existing one. This is what's called loan right refinancing. Essentially, I get a bank to give me a new loan, I used the money from the new loan to pay off my original loan. And then, instead of paying the original loan, I now pay the new loan, which is under the new contract. And now that rates have fallen so much, this has become an enormously attractive option for a great many people, whose current loan contract specifies much higher rates than are currently available in the market. So once again, we have seen historic, and I keep finding myself needing to use the word historic, so that's how you know how weird things are financially right now. But we have seen historic rates of people rushing to refinance their existing loans. They're trying to get out of their old contracts by replacing them with new contracts at lower rates. And by doing so, they are collectively saving millions of dollars of interest over the remaining maturity of their home and car loans. So the Fed dropping interest rates has provided a huge boost to the economy on the consumer side. What we hope and what remains to be seen is whether this is also going to provide a needed boost on the business side. And that's why this is what you see all over the news. And that's why this is what you see people talking about. And that's what the hell is going on with interest rates.